Hi, welcome back to my financial analysis classes. Now another lecture. We are going to understand the different classification of assets. So today lecture is about classification of assets, characteristics of subtypes of securities. That means just here we are understanding the different kinds of assets. And my name is Mr. K. Kiran Kumar, Assistant Professor, Chris Jayanti College, Autonomous, Bangalore. Yes, first we will try to classify the assets for easy to understand. Financial assets include securities like stock bonds, derivative contracts, currencies. Real assets include real estate, equipment, commodities, and other physical assets. So we will try to understand all these different kinds of instruments or assets. So first one is public traded. So very simple, public traded means those company securities or assets traded in publicly. Okay, those are available for selling and buying in trading or any place publicly. Then we called it as a public traded securities. Next, derivatives. Of course, you know very well the meaning of derivative. That means deriving the value from other asset. That is called as derivatives. So derivatives point of view, there are different products are also available, like in security exchanges or commodity exchanges. Third one, spot markets. A spot market means on the spot. Okay, uh, call option and put option. Suppose if anybody plan to buy, okay, or if anybody plan to sell, okay, so these kind of trading activities maybe comes under the spot market. Next, the primary market. Of course, market can be classified into two, that is primary market and secondary market. So as you know very well about this primary market is nothing but when a company issue the shares for the first time into the market. When a company issue shares for the first time. Okay. Next, money market. So those instruments are traded in the market, and those instruments are having less than 1 year maturity period, like promissory notes, treasury bills, certificate of deposits. These are the examples for money market instruments. And last one is traditional investments. Traditional investments like investing in real estate, investing in gold. Okay, like these are the examples for traditional investments. So like that we can classify the assets based on the nature of the assets or characteristics of the assets. Now, subtypes of securities. That means there are many securities which comes under majorly whatever we discussed in our previous slide, like real estate, trade, traditional investments, securities, public traded, derivatives, spot markets. So again under that there are some other securities are also traded. But only thing is we should understand those meanings of all these securities. So first one is securities. It deals with the stock market, stock exchanges, selling and buying through recognized stock exchanges. And the convertible debt, of course we know the meaning of debt, but the nature of convertible means those debts are having the nature of converting from debt to equity. Okay, of course there are different types of debts are there. Next, equity securities. These are all like a securities which are traded in the stock exchanges. Common stocks are also same, like a see here, preferred stock under common stocks, equity securities and preferred stocks. So preferred stocks are also having a preference, while payment of dividends are winding up of the company point of view, these people will get the preference. and warrants. So warrant is just like a one of the derivative, or it is just mm, like a contract, okay, between the two parties. And the mutual funds, mutual fund is a process of pool money from the public and investing into the different securities and generating profits returned to the members. So, okay, you know already the function of mutual funds. ETF, exchange traded funds, it is also one kind of like a basket or like a group of securities included in one thing. Okay, only thing is the particular person has to manage and track all the selected securities in this exchange traded funds. Asset backed securities, asset backed securities means by keeping something to other, or by keeping something and taking loan, like a mortgage finance, car finance, mortgages, okay, gold loans, maybe these are also hedge funds, even for reducing risk. Here investors go through this hedging funds. Currencies, so foreign currencies, there is a separate market for currencies, that is forex market. And the contract, suppose if any contract is made between the two parties, when the both parties are agreed to exchange their goods, it may be called as a contract. And the same like under derivatives, there are different contracts are there: forward contract, future contract, swap contract, option contract. So these are the four major instruments. And the forward contract point of view, here an agreement is made today at a predetermined date at a specific price. Same like that futures, but futures are having standard norms, where forward contract is not having. And the swap means just swapping interest rates or currencies. Option, it is a call option or put option whenever a buyer or seller want to buy, it is an option, okay. Yes. Next, insurance contract, just to protecting ourselves or protecting the person, he may go for buy the any securities. At that time, say he also making an agreement or contract with the insurance company. Credit default risk, if any person become a defaulter or unable to pay, then he become the credit defaulter. Commodities, so there are many products are traded in the commodity exchanges. Even commodities are also a one kind of asset. And real estate, as you know very well, nowadays many people are investing in the real estates for getting their own home. Now last one is market regulations. So these are all, this is very important to regulating the markets, otherwise investors may not trust to invest in these assets. So first objective is protect unsophisticated investors, so that trust in the markets is preserved. Trust is very important. Now tell me how we are good, on what basis we are investing in stock market, and what criteria we are depositing in the bank. Why? Because for banks there is a strong regulatory body, RBI. For stock exchanges there is a SEBI regulatory body. So these bodies are always regulating their companies, are regulating their exchanges. Require minimum standards of competency and make it easier for investors to evaluate performance. Next, prevent insiders from exploiting other investors. This is very important. Suppose insider is nothing but those who are having sensitive information which is not supposed to disclose in the market. Suppose if any company or if any person did a mistake or did this insider, then he may be punishable. Okay, this also prevent by the regulator. Require common financial reporting requirements. Okay, so here regulatory body always going through their published or disclose annual reports. And here SEBI or any accounting standard board will see whether their financial reports are prepared correctly or not, whether provided information is sufficient, and is it whether sufficient or correct or not. Suppose if any accounts or reports are having misstatements or wrongful information, immediately this regulatory body will take a action. So financial reporting requirements is also very important, so that information gathering is very less expensive, and even investors will take the decision based on the published annual report. So it is compulsory to publish annual reports into the market by the companies. And last one is require minimum levels of capital so that companies can participate and will be able to honor their long time commitments. So capital, based on the capital also, here companies can list into the market, and companies can expand their business. This is especially important for insurance companies and pension funds that individuals depend on for their financial future. With capital at stake, market participants have more incentive to be careful about the risk they take. I'll give example. Suppose whatever money collected from the public by offering the different insurance products to the members, they should go for invest into the other avenues for generating profits. So when insurance companies plan to invest into other companies, they have to be very careful before going to invest into the particular company for generating profits. So with this regard, here like insurance companies can also see the capital. Of course, this is one criteria, one parameter or one criteria before going to investing in any company. So these are the